I've been trading for over 12 years, and I can confidently say that I've pretty much tried every single strategy out there. If it's a strategy that has a name, I've probably tried it, okay? But in this video, I'm going to show you the one strategy that has completely changed my trading, and I don't even think it's anywhere else on the internet. Seriously, I haven't seen anyone teaching this just yet, so you're in for a super valuable video. As long as you can watch it to the end, your mind is about to be blown. I'm going to provide you with a checklist of this strategy so you can literally go and start today. And we're also going to take a look at some real-time live trade examples of the strategy in action. So I promise if there was one video you were going to watch on supply and demand, make it this one, watch it to the end. And with that being said, let's get into it. Okay, now before we hit the charts, let's just quickly go over what is supply and demand, because supply and demand pretty much runs every single market in the entire world. All right, so here's a simple example of supply and demand in action. If you have one person, that's your demand, and you have one cookie, that's your supply, okay, the price is going to be the price, right? It's just going to be a normal price. It's not going to go up. It's not going to go down. There is a balance, right, of supply and demand. The demand is equal to the supply. Now, let's say you have 3 cookies, but still you just have one person that's in the market for cookies. Well, now you have more supply than you do demand, and so the cookies are going to have to drop in price because there's more cookies than there actually is demand for those cookies. The supply is higher than the demand. Now let's flip that on its head and say now there are 3 people that want cookies, but there's only one cookie. Well, now the demand has gone up, the supply has gone down, and so the price of that cookie is going to increase, all right? So if there's more demand than there is supply, then the price is going to increase. If there's less demand than there is supply, then price is going to decrease. And if there's an equal demand for the supply, then the price is going to stay the same, okay? That is a very basic explanation of what supply and demand is. Now, before we get into how to use supply and demand in trading, let's first discern it from support and resistance, because while demand and supply can act as levels of support and resistance, they are not the same as traditional support and resistance levels. I'm sure if you're watching this, you may be either a beginner to advanced trader, and even then you've probably seen how to mark out a level of support and resistance in the traditional sense, okay? This is probably going to be an area of resistance for you, and this down here is probably going to be an area of support. Traditionally speaking, support and resistance are just previous highs and lows, previous areas where price has reacted in the past. That is support and resistance in the traditional sense. But supply and demand is a little bit different. Supply and demand aims to find imbalances in the market rather than finding places where price has reacted historically. We are now looking for an area where price had a sharp reaction from a specific price point that indicates that there was some kind of imbalance between the supply and demand. Basically, an imbalance between the amount of buyers and sellers. That's essentially what supply and demand is, okay? So, supply and demand is going to look something like this. Rather than, for example, you mark out these highs as an area of resistance, the area where there was an imbalance is actually going to be this area right here, all right? And you can actually see that is where price reacted. And down below here, this is going to be an area of imbalance or an area of supply and demand right there. All right, now there are other levels of supply and demand on this chart, but these are the 2 most obvious and obviously the best examples of supply and demand. Okay, so you can see using these levels of supply and demand would have netted you some pretty nice trades, whether you were shorting here or buying here, compared to if you were just selling at the tops here and trying to buy at the bottoms here, right? Because those would be the 2 obvious levels of support and resistance. So now let's talk about how to identify supply and demand specifically. Now you've seen what they look like in general, but let's talk about how to actually find them on your charts. So on the top here, we have examples of demand. Now, people can get extremely nitpicky about how to identify supply and demand. And let me tell you, as the simple trader, I like to keep it really simple. I don't have extremely strict rules when it comes to identifying levels of supply and demand. It doesn't have to be, X amount of points or the candle has to be this size compared to the next candle. No. In general, the way to identify a level of demand is going to be a consolidation candle followed by a massive move to the upside. All right, and the consolidation candle, can be either green or red. It doesn't matter to me, okay? So basically what you're looking for is you're looking for a consolidation before a continuation. Usually that's going to look like a candle with some pretty long wicks, whether it be up or down, and then some pretty big solid candles to the upside, okay? In this example here, it is a red candle instead of a green candle, but it's nonetheless an area where we saw consolidation, right? We formed this little doji candle or hammer candle, who cares, right? It's just a consolidation candle followed by a few large candles to the upside where we clearly see there was an imbalance of buy orders in this area, right? Clearly, right here is the point at which a move to the upside, an aggressive move to the upside happened. And again here, clearly, right here is the point in which we saw an aggressive move to the upside. So obviously, what that means is that there were lots of buy orders that entered the market in these areas. So that is demand. Demand is going to be your levels of support, basically. Now, supply, on the other hand, is going to be the exact same thing, but now we are just looking for large moves to the downside. Okay, so here is your area of supply right here. You have a consolidation candle followed by a massive push lower, right, all the way down to here. So clearly there was an imbalance that happened here with the sell orders, and we came right back into that area, the imbalance, and then a massive push lower from there. And again here, a lot of people are probably going to say this is not a valid level of supply, but for me it is. Why? Because it is a short candle where not a lot of movement took place, and then what followed that was a massive straight move lower, okay? So this to me is the candle prior to that massive move lower. So there was an imbalance beginning with this candle, okay? And you can see right there that this level ended up holding very well. These levels, when they are identified the right way, okay, they work extremely well. These are probably going to be some of the best levels you can possibly mark out on a chart, trust me. Now, you may be a little bit confused here as to why these levels work. So let's talk about that. Why do these levels work? Well, it's very simple. There's pretty much two reasons. Reason number one, it creates an imbalance of orders, okay? So what ends up happening is you have orders that are not filled because price moved so quickly in one direction, right? If you have orders sitting here, sell orders or buy orders sitting here, and price immediately skyrockets up and away from those orders, well, now clearly there was an interest of buying here, or clearly there was an interest of selling here, but price moved very quickly away from that area. So what happens is there's an imbalance of unfilled orders, and so there are buy orders sitting in this area. And the only way markets move are with buy and sell orders, right? Same thing with this supply example. Price moved away from this area extremely quickly, so there is interest in selling here that has not fully completed. Okay, so once we come back into that area, those orders can be filled and price can continue with its move. All right, so that is the first reason. The second reason is going to be that it traps traders, okay? And I don't really see people talking about this much, but it is true. If you are, for example, a seller in this wick right here, you can clearly see that obviously we had sellers in this wick, right? Well, if you're selling anywhere in here and all of a sudden price moves up and away without ever coming back, right? You are now trapped in a short position all through this pain, right? You're going to go through a lot of pain. So now, if you're trapped here, once price gets back into that area, well, now you can finally get out of your trade for a small loser, a small break even, or maybe even a small winner, okay? So the trapped traders also act as liquidity or, orders for the market. So let's say, for example, here you were buying here, right towards this top, and then all of a sudden you get this massive move lower. Well, now you're going through all of this pain. And so when price finally gets back up to that area where you were buying right here, you're going to see a reaction. You're going to see people getting out of their trades there. And the only way to get out of a buy position is to sell, right? So you get sell orders. Not only do you get sell orders from the people that wanted to sell there, but now you get sell orders from the people that bought there as well, all right? So that is the theory behind supply and demand and why supply and demand works. It creates an imbalance and it traps traders, which basically just creates orders, right? You need orders to actually move a market. Okay, so now let's do a little exercise. Pause the video for maybe 3 seconds and see if you can identify the demand zones in this chart right here. Okay, so the demand levels in this chart are right in here and right over here. Okay, so you can see price had this large move away from this little candle here. I mean, not really the smallest candle, not really the most consolidated candle, but nonetheless, this is the origin point of this large move. So this is where the imbalance was created. We get a move back into that level of demand, you can see here, and actually create another level of demand. And by doing so, technically, we create, again, another level of demand because we had that large move higher that originated from this candle right here. And you can see here we came back down in and we actually retested that first level of demand, and there you go. You got that big move higher from there. And yes, technically now we would have another level of demand right here, right? Because this candle is a consolidation and the origin point for the massive move higher. So there is demand there now. All right, now let's do the same thing with supply. I'm gonna give you a few seconds, pause the video. All right, so the supply levels in this chart are going to be right here and right in here. And I'm sure there's probably more areas, but these are just the two most obvious that stuck out to me. Okay, why are these areas supply? Well, right here, we had that consolidation candle, that long wick, the consolidation, the origin point of this big move lower, and then we have here a small green candle, small buying candle consolidation before this large move here. And you can see both areas of supply offered some pretty nice spots to short at, right? Good levels of resistance. Okay, now I know what you're thinking. I've tried supply and demand before. It doesn't work. Now I can agree that supply and demand levels on their own are not going to be the holy grail. While they still do offer some of the best areas to be buying and selling, it is not going to be all you need for a trading strategy. And I have tried supply and demand before in the past as well. I've failed with it many times, but it wasn't until I started doing this one trick that has completely changed it for me, and it has just blown my mind ever since I've discovered this. So what is this elusive secret? So before we get into that, we need to answer the question, why do markets move? If there was an equal amount of buyers and sellers, well, that would be a balanced market and price would never move, right? In order for price to move, you need an imbalance. Whether it be one way or the other, we need either more buyers than sellers or more sellers than buyers, right? We need to have a pressure on one side of the scale, a weight on one side of the scale. If there is no imbalance, then price doesn't move. But to be more specific, what actually moves the market is liquidity, okay? Now, I'm not going to go into a huge rant on liquidity because it's pretty simple. It's literally just stop loss orders that are sitting above highs or sitting below lows, right? If you are even a new trader, I'm sure that you've heard that you should always put your stop loss, if you're short, above a strong high, and if you're buying, you should always put a stop loss below a strong low. And if you're doing this, I'm sure you've realized by now that every time you buy, your stop loss gets hit and then it reverses. And every time you sell, your stop loss gets hit and it reverses, right? And that is because liquidity is what moves the markets. In general, more orders are going to be resting above highs and below lows because that's what everybody is taught to use for their stop loss orders, or even breakout traders, right? Breakout orders, okay? In general, there are, and this is proven, more orders below lows and above highs than pretty much anywhere else. Whether you're looking for a breakout or you have a stop loss sitting there, there is orders there. And what do orders offer larger institutions? They offer them liquidity. Okay, what is liquidity? Okay, it's a big fancy word. It just means if you want to sell, somebody needs to be buying. And if you want to buy, somebody needs to be selling. So if you're an institution, stop losses here are going to be what? They are going to be sell orders, right? Because there are people buying here and then they get stopped out here. So those are going to be sell orders. Well, if you're a big buyer in the market, you need a lot of orders to actually participate in the market. If you're buying 1 billion shares, you need 1 billion, shares sold to you, right? So if you need that amount, you can't just go and buy the market. You have to actually target areas where there's going to be those people willing to sell to you. Okay, and so what's the best area with the most sell orders? It's going to be right here. The stop losses, all of the sell orders sitting below the lows, and vice versa here. All of the orders sitting above the highs for institutions to go short, because these are now going to be buy orders, whether they're breakout traders buying for the breakout or buy orders to get out of a short position, right? In short, orders move the market. That's pretty much it. You need to find the area where you have the most orders sitting, right? So when you combined supply and demand plus liquidity, that equals the big bucks, baby. When you combined imbalance orders caused by supply and demand and liquidity orders caused by, well, lows and highs, that gives you an area where you have a very, very large, I don't even know what I was going to put there, large imbalance, okay? Because now you have the orders from the supply and demand and the orders from the liquidity, and so that is going to be a very precise area to be buying or selling. So first off, why does it work? Here's an example right here. As you can see here, we have a consolidation candle followed by a large move higher. So this candle in general is going to be an area of demand. Great, but now we don't want to just blindly buy at this candle. What we want to do is we want to wait for liquidity to also form in this area of demand. And where is liquidity lying? Below lows. So what we do is we wait for that liquidity form first. So in this case, this candle right here forms a low. You can see we make this small lower high here. So we form a low here. And now what ends up happening is you now have buy orders, unfilled buy orders right in here. And you also have orders sitting right under this low that is also going to act as liquidity, right? So you have unfilled buy orders from this level of demand. You have trapped traders from this level of demand. And then you have breakout traders that are putting their short positions right under this low, their short orders, their sell orders. And then you have the traders that are already bought into this move. They're putting their stop losses below this low as well, which is also sell orders, right? And if you're buying, you need to have someone to sell it to you, right? So all of this combined just creates a big fat area of orders, and orders move the market. Now here's another trick, and this is my little secret that I'm sharing with you here. Supply and demand plus liquidity plus an ABCD pattern completing in that general area as well. This is my A+ setup, and I'll show you some examples. You'll see some live examples very soon. Now, what is an ABCD pattern? Really quickly, it's the most simple pattern in all of trading. All a ABCD pattern is an equivalent move lower or higher, okay? So you have the A to B leg. A to B is the same length as C to D, this leg right here, okay? These are the same exact length, and it just represents an equivalent move in either direction. And I'll show you again, you'll see how we actually use this. So having one of these patterns completing, and the pattern completes at the D point, that's where you buy, this is where you sell, okay? Having one of these patterns completing in your area is the A+ setup as well. Now, the moment you've all been waiting for. Let's take a look at some examples. So this is an example of an A+ setup, okay? We have an area of demand right here caused by the consolidation followed by the continuation. Then we have an area of liquidity resting just below these lows right here. So now we have the perfect area where we have stop losses sitting under this low, and we have the imbalance caused by this sharp move higher. Okay, so now we're building our zone of orders, right? And then to top it all off, what makes this an A+ setup is going to be the ABCD pattern that forms here. So we take a line from the high to low, and I can't actually grab this line, so I'm just going to draw it for you here. It's probably going to look something like that, all right? About the same size there. On TradingView, you can just copy and paste. I'm just using a drawing tool here that I can't copy and paste, okay? But this is an ABCD pattern. You basically take the same leg, copy and paste it to this high here, project that forward, and now you have your ABCD pattern completing right here. This is an A+ setup. You have your demand zone, you have your liquidity, and you have your ABCD pattern completing right at that level. okay? And this is pretty much your buy point right here. And that would have worked beautifully, obviously. Now let's take a look at another example. This one is not going to have the ABCD pattern on it, but it is still a valid trade setup. This is going to be a short trade setup. I'll let you pause the video for a second. Go ahead. See if you can spot the setup before I do. The level of demand that we're looking for is right here, okay? This is the consolidation before the continuation, right? So not the level of demand, the level of supply, right? That is our level of supply. Take a look to a little bit to the right, and we'll see that we have liquidity forming right here. Okay, the first test of this zone, it created a strong high. People are going to put their stop losses above that wick, right? And then as soon as we take out that liquidity, this is going to be where you are looking to short, just above that liquidity into that area of supply. And as you can see, that would have been a great trade. Now let's talk about risk management, because you can't have a good strategy without talking about risk management. So let's talk about ATR. This is what we're going to be using for our risk management on this strategy. If our theory is correct, these levels should work right away, right? Because our theory is that there are a lot of orders sitting at this area. So if there's a lot of orders sitting there, is price just going to blow right through it? Is price going to stay there for a while? Or is it going to hit that area and immediately reverse, right? It's the latter. It's the last of those, right? If our theory is correct that these areas have a lot of orders sitting there, they should be able to hold very quickly, and we should be able to use tight risk management. We shouldn't give it a lot of room, because it shouldn't need a lot of room to work if there are actually orders sitting there. In order to do this, we use the ATR, which stands for average true range. What is average true range? Well, what is a range? A range of a candle is just the difference between its high and its low, okay? So the range is the difference between these two. The average true range basically just takes the range of the past 7 candles. That's what I use, 7. It takes the average range, so it takes the last 7 candles, takes the difference between their highs and lows, and puts it into an average range. Okay, that is what average true range stands for. Why does this work? Well, it's basically telling us, on average, how much is any given candle going to move. Okay, and by using one ATR, we are basically placing our stop loss one range, one average true range away from our entry point. Okay, so this is an example of what ATR looks like on my trading view. As you can see, this was the NQ or the MNQ, and the average range was 20.86. So that means on any given candle, the range of that candle, the amount it's going to move on that 1 minute time frame, because this is 1 minute time frame, is going to be about 20 points. Okay, so our stop loss would be 20 points. The reason is that we shouldn't see much more of a move past our zones. So even just one ATR into our zone is pretty much showing us signs that the zone may not hold. Okay, so stop loss is one ATR, and we immediately go to a break even if we get to around +1 or +2 ATR. So if we were to move 20 points in favor in our trade, 20 points to the upside, 20 points to the downside, then we would move to break even. Or if you want to be a little less aggressive, you can do 2 ATR. So in that case, that would be 40 points, okay? If price moves 40 points in your direction, in your favor, then you can go to a break even. But basically, the idea is we want to be aggressive when trading the strategy, because the levels should hold very well most of the time. And so if it's not holding, you just want to get out of it. Now, let's put it all together. Let's go take a look at some live trade examples. And after that, I'm going to give you the checklist for this strategy so that you can just turn off your brain and follow a simple checklist and not have to think. All right, so here we have our first live trade example. This is on the MNQ. By the way, this strategy works on anything, not just futures. So where is the setup? What is the setup here? You can see it's already going into my favor. Have a very tight stop loss, roughly about 1 ATR. The level of supply you can see is right here over to the left. That is a clear level of supply. Most importantly, though, we have a liquidity sweep happening right here, a level of liquidity. And don't mind me, I'm just measuring out the risk to reward here. So we have everything we need for a trade setup. We have a liquidity level just before our area of supply, and then we have our area of supply right over here. So I put my limit order a little bit into that area, and as you can see, it's starting to pay off pretty well. Now, what's going to happen is price did already technically move 1 ATR in my favor, but I'm a little bit more experienced with this trading strategy, and I know that a lot of the times I'll get stopped out for break even and then price will reverse. So what I did instead was just tighten my risk. I made my stop loss pretty much half of what it was before, And so that's just going to give me a little bit more room in case this thing does decide to kind of, you know, whip around before actually making its move lower, okay? Which I believe it actually does do that, and I get pretty freaking lucky. Is it luck or is it skill? Who knows? All right, let's fast forward a little bit here. You can see price starting to move against me, and we break through that high. So this is essentially another liquidity sweep right here, right? And I'm pretty much convinced I'm about to be stopped out, but the reason why my stop loss is above those highs is because of that, right? I usually get stopped out for break even, not usually anymore because I fixed myself, but it is very common to get stopped out for break even and then price moves in your favor. So I just avoided that with the stop loss being a good amount above that level of liquidity. And as you can see, this trade is now very well in my favor, and I believe I was in the bathroom while this was going on, so I'm not changing my stop loss just yet, but I'm sure I will as we move on. Oh, no, I don't even get a chance. All right, so this trade does go and immediately just spike right down and hit targets down there, and the target is just another level of liquidity, right? It's just the lows. Usually I'm either targeting the highs or the lows. So that was a pretty nice trade, and I actually think if we fast forward a little bit, oh yeah, there's me telling the Discord about it. Free Discord, go ahead and join that. Fast forward a little bit. Yeah, this was pretty much a perfect exit as well. You can see price comes right back up to that entry point. So pretty much a perfect entry and a perfect exit. And that's what happens when you are trading with where the orders are, right? Where is the orders? Where are the orders? That is what you have to be thinking about. All right, so now moving on to the next example, it is going to be another short trade. We're going to see we have this area of supply right in here, the consolidation prior to the continuation, right? And more importantly, we have an area of liquidity resting just above these highs. So we again have a liquidity zone and a supply zone, and that means that we are going to have likely a lot of orders sitting in this general area, right? So I placed my limit order just right before that zone. Stop loss is about 1 ATR to the upside. And now let's take a look and see what happens. Fast forward a little bit. I got executed right there. All right. And it was pretty scary. You can see that price is pretty strongly pushing into that area, but you don't really want price to fake you out. Even if price is strong into the area, it's not a good idea to try to cancel your orders and be a wussy. All right, price will usually have a strong spike into the area and then a strong spike out of the area a lot of the time. So just a pro tip right there. All right, let's fast forward this. You can see it starts going against me a little bit, starts to run back down, get a nice candle there, and a great candle there. Okay, so pretty much a perfect entry once again. My stop loss is now at a break even, as you can see right there with that blue line. My target are the lows right here, but I don't believe I'm actually going to hold this all the way through. I can't remember why. This is actually today's session, but I actually just don't remember why I was not feeling good about holding this all the way through. I think it's the volatility. It looked like we were going to take out this liquidity and move higher. So I believe I sold, yeah, I bought back one right at this area of liquidity. And so you're about to see we're going to move lower, and I actually aggressively move my stop loss to trail, seeing if I could just capture, you know, a big move down if it did decide to do that, but I didn't want to really give it too much room to run, all right? So I put my stop loss close to that area, and it actually executed 2 contracts, so I was actually in a position there for a second. But that was the end of the trade there. All right, and as promised, here is the simple trader checklist for this strategy. Screenshot it, do whatever you want. If you enjoyed the video, make sure to smash up the like button, subscribe, join the free Discord if you want to get funded with Take Profit Trader or any prop firms. I got links in the description down below for the best prop firm options, with good discounts as well. Everything, link in the description down below. Do the things. I'll see you guys in the next video. Peace.